The widow's tax trap. Much ado about nothing? What? My man Ed McQuarrie, who had written this wonderful article, Stocks for the Long Run, sometimes yes, sometimes no, had written a 213-page thesis or diatribe, however you want to look at it, on historical rates of return for bonds, which I read, and I noticed that there is some discrepancies about other published professors' historical returns of bonds relative to Ed's, relative to Ibbotson over, and I just, something odd, grasping at straws, it appears, that on the historical rates of return for bonds. Anyway, the point being is I like Ed's stuff. I think Ed's probably a rabble-rouser. He sees a topic that's generating steam, and he says, oh, I'm going to try to bust that bubble or pierce that bubble. And I like that, man. I actually, when I saw the widow's tax trap, that is near and dear to my heart, because I think I am, if not the chief proponent of the widow's tax trap, one of them for sure. Just your old buddy Josh, I haven't shaved, with my dog's my t-shirt, because in my book right here, we talk about the widow's tax trap a lot. And one of my chapters is, this widow paid $9,623 on tax, while another paid nothing on the same income, because that's the widow's tax trap. We talk about it a lot in here, by the way. And you should get it. If you haven't got my book, The Tax Bomb in Your Retirement Account, you're wrong. R-O-N-G, you're wrong. Anyway, so Ed's got this interesting article, which we'll read a little bit here. We'll have fun, and we're gonna take him to task in a fun way. I'm not bashing the guy, probably a little bit, because again, I think Ed probably has a disdain for the financial advisors, frankly, and I think he's trying to kind of fit a square peg into a circle with his distaste for financial advisors here. And there's some straw men, and I hate straw man arguments. I hate it. But we'll go into it. By the way, if you like what we're doing here, I got my new book out. Don't forget to buy that. Buy it on Kindle and buy it on the you want the physical for sure. And of course, don't forget to support me by buying me a cup of coffee, man. Buy a cup of coffee. Decaf is in the doobie doo. I mean, $5, cup of decaf. I'll take it. All right, so anyway, so here we go. If there were a list of top 10 fear appeals used by financial advisors, the widow's tax trap would surely rank high on the list. And again, I am the one who came up with the term the widow's tax trap. He calls it the widow's tax hit, because I'm going to trademark that. I probably won't, but you know what I'm saying. The fear is easily stoked by an apparently impregnable argument. Now, he had written this in 2021, which is, I guess, doesn't show here, but it's 2021. I published this book in 2019. This book was already getting traction. I don't know if Ed Slott was talking about the widow's tax trap in his book he had written in 2010 or 11. I forgot what that book is. But Ed Slott had done a book that gave me a lot of thought process for mine. I like Ed Slott. But I don't think Ed Slott talked about the widow's tax trap the way I did, for sure. And I could be wrong. I don't think he did. I think it literally, and maybe I'm being arrogant, don't care. I think I'm one of the chief prognosticators, people promoting the fact that there is a widow's tax trap. I mean, I might be wrong. I don't think so. All right, so the fear is easily stoked by an apparently impregnable argument. 1, although the couple may enjoy comfortable income, that is because as a married filing jointly, they're located not too far up the tax bracket structure where tax rates are low. All right, so they're enjoying a comfortable income, but they're paying low taxes. Unfortunately, the widow will have to pay taxes as a single where the brackets are half of that as married filing jointly. So, all right, so they're enjoying a good, comfortable retirement. The husband dies, and they're not in a high tax bracket. The husband dies, and all of a sudden the widow will have to pay more tax because she's no longer married filing jointly. Her tax rate to rise, she goes up the tax bracket ladder even as her income drops. So all these three things make sense. They're enjoying a comfortable retirement in a low tax bracket. Husband dies. The wife now has, she no longer has a married filing jointly tax brackets. She is a single taxpayer, which means her tax bracket goes up the ladder while her income goes down because of loss of things like Social Security. And then this right here, leading to a significant crimp in her lifestyle if something is not done. Now, that is a straw man, and he has a 1 there for, we're going to show what he's referring to here. I forgot. That was actually because he's academic. He's got to make sure he's not misgendering people. So he says, causing her tax rate, it could be his tax rate, Ed. Oh my goodness, you're fired because you're misgendering people. I don't know what the hell, but anyway. But so that 1 doesn't indicate anything. Anyway, leading to a significant crimp. Now notice the adjective significant. Is that the right, is it an adjective? I don't know. A large crimp, a large decline in lifestyle. That's what Ed is surmising from the widow's tax trap. If you get faced with a widow's tax trap, inherently it's going to lead you to a significant decline in your lifestyle. All right. No one says that, at least I'm aware. Maybe someone does. I don't. I never said one time, oh, if you don't deal with the widow's tax trap, your surviving spouse will be eating cat food. So that's a freaking straw man. We're going to set up this straw man argument is we're going to set up a false argument that no one made in order to tear it down and make us look good. That's the straw man. So he's going to tear down this argument. This whole thing is based on false premise, a false straw man. This whole article. We're setting it up that Charlotte, upon my demise, her lifestyle will be greatly affected to the negative if we don't do something about the widow's tax trap. No one has made that argument in terms of why you need to be cautious of the widow's tax trap. No one said that. And so Ed's whole premise is based on that, which is a straw man. And I hate straw man arguments because they're freaking fake, dude. So let's keep going. So Ed says the thrust of this paper is for retirees to relax and let go of the fear. In general case, a tax hit such as it will be, should not be a cause for concern. All right? So he's saying, no big deal, man, no big deal. And here we go with another straw man. Everyone knows that the widow's tax hit is real and threatening. No one's saying it's threatening, Ed. Since I will be arguing that just ain't so, it is important to explain how this mistaken idea could have taken root. The behavioral finance literature provides insight. And he's talking about this book right here by Daniel Kahneman, which won the Nobel Prize, and his partner in crime, Amos Tversky. Behavioral finance after Kahneman took off like a bat out of hell, and it's a lot of it is just psychobabble, frankly. But there is some legitimacy of it. We know for a fact that people despise losing twice as much as they enjoy winning, if that makes sense. So if you had $100 and you lost $50, that would be twice the pain than the $100 going to $150 would be joyful. Does that make sense? Losing is twice as more emotional than winning is. And, you know, Kahneman kind of came up with that. That's fine. But a lot of stuff in here. This book, that's a lot of Gooby-Dook, and then we got some, not Kahneman so much. A lot of the financial, behavioral finance is just psychobabble stuff. You just want to jump off a bridge head first after you slice your wrist into an ocean of starving great white sharks. You know what I'm saying? Because you're like, can we just use some common sense? But anyway, Tversky died before the Nobel Prize was awarded to Kahneman, and there was some controversy on that. Actually, it's pretty interesting. You should look at the controversy between Tversky not getting the Nobel Prize. But at least my man Ed does cite Tversky in this, right here in this, that footnote there. All right, so let's keep going. In the case of the widow's tax, the most available information is the halving of the tax bracket levels for the survivor. This erroneous inference that follows, and again, straw man. The poor widow will now be paying perhaps twice the amount of tax, or paying twice as high as the tax rate, or must face some burden that is twice as high, causing them to live only half as well. That's complete straw man. That's, again, he's making this argument up to knock it down. The argument hasn't been made. I don't know why Ed would do that, other than he wants to bash the financial industry. I can't stand straw man arguments, man. This is 100%. The erroneous inference is that the poor widow will be paying twice the amount of tax. No one's saying that. Or paying twice the high tax rate. Yes, that is true. That could be true. It doesn't necessarily mean it's true, but that could be true for sure. The high tax rate is not the same as twice the amount of tax in dollars, Ed, and he knows this, and he's talking about it later. Or must face, again, the word must, no one said that, must face some burden that is twice as high, causing them to live only half as well. That's complete straw man speculation, stupid. And then, of course, we go to all these guys, the spreadsheet setup. I'm like, this is where the academics drive me up the wall. Everything's a spreadsheet for these guys. This isn't the real world. The argument thus far has been focused on the need to avoid well-known cognitive biases and construct a spreadsheet setup, because spreadsheets don't have any cognitive, because I program it and it tells me what I want to see. Because there's cognitive biases in there too. Only then can the inequality that underwrites the widow's tax trap be put to the test. All right, so we're going to keep going down here, because that's in of itself. The spreadsheet is not a living, breathing thing. The spreadsheet has no emotions, no love. It's inanimate, just like a firearm. The spreadsheet cannot do anything other than what it's told to do by the programmer, who's a human being. And as such, if you're living through the spreadsheet, well, that's just silly and sad, because a spreadsheet isn't humans. Humans have different approaches when it comes to their brains, the level of emotions, what they want to do, even if it goes against a spreadsheet. All right, now we could say it's irrational behavior. The spreadsheet would tell you what's rational according to whom? According to the person who programmed the spreadsheet. So if I go to Y and the spreadsheet goes X, it says I should go X, and I go Y, the spreadsheet would say I'm being irrational. I'm being irrational. I'm not being irrational. That's the decision I made. It's rational for me, even though it's irrational for the spreadsheet. Not the spreadsheet, the programmer. Let's keep going. So here it goes. As seen in Table 1, even though and I'm going to show you here in just a second, even though survivors' adjusted gross income drops by $30,000, their income tax payments go up, just as feared. Furthermore, whereas the couple only had been in the first IRMA bracket, the survivor will have to pay the first 3 IRMA brackets. Will have to pay the first, so it should have been the 3 IRMA brackets. So the IRMA dollars also increase, even though only one person now is paying IRMA. So here we go. Here's when was it? Table 130. I got right here. I'm just go right here. All right. So here's a couple. All right. We're going to see right here. We're going to see their taxable income is $81,000 married, $76,000 single. All right. So the taxable income dropped by $5,000. On the other hand, the income tax went up from $9,000 to $12,000. All right. So we have an increase in income tax of 30. What's that? 3 divided by 9. That's 33%, isn't it? Yeah. 3 divided by 9. A 33% income tax. That is a fact. That is 100% a fact that happened. Their income, again, if we actually look at their taxable income, but we're going to look back down here because it makes sense. Let's see here. Their disposable income fell from $98,000 for the married couple to $77,000 for the widow. Their disposable income fell by $21,000. So tax, remember, it's like keep 2 books as a small business owner. You keep the IRS books and then your day-to-day operating books. Same kind of thing here. We're keeping 2 books when it comes to taxable income versus your total income that you have. So their income went from $98,000 to $77,000, which was a $21,000 drop. And this is Ed, and he's going to show why he's going to bat this down because this is 100% true. Their disposable income went down by $21,000, but their taxes went up by 33%. And that is a fact. That can't be disputed, 100%. And this is Ed's own stuff. Now, he's going to try to bat this down by saying this is not that big of a deal. I'm going to show you why that's silly. All right, again, disposable income went down by, we'll just say 20 to 25%. Taxes went up by 33%. All right, let's keep going. But none of these adverse changes amount to much in dollar terms. What? Doesn't amount to much in dollar terms. That's $3,000, Ed. $3,000. That's $250 a month. That's the cost of your freaking Medicare right there, Part B and Part D, and a little bit out of pocket too. That's real money. The survivor's effective tax rate is always substantially higher, but again, it does not matter because the effective tax rate for the couple has not been very high. See, this is the problem. It's just crazy. The big percentage increase in effective tax rate only translates to some thousands of dollars of. See, this is the professor stuff that's nuts. The big percentage increase in effective tax rate only translates to some thousands of dollars of extra tax payments. That's thousands of dollars of extra tax payments, Ed. For couples with retirement income between $100,000 and $150,000, it is a mistake to fear the widow's tax trap. Lost income is always to be feared. So Ed is saying, look, you're not losing that much in taxes. You're only losing, freaking $3,000 in taxes, $2,000 in taxes. You're not losing that much. What you should really be worried about is the lost income, this number right here, the reduction of disposable income. Okay. Lost income, where was it, right? Hold a second, right? On the other hand, lost income is always to be feared. Had more than 20% of income disappeared at death, disposable income might have been reduced by 25%, sending a warning. But the problem would have been the income loss, not the widow's tax hit. These aren't mutually exclusive things, Ed. They're compounding. So let's just go right here. So we have $21,000 of loss of disposable income, which on $98,000, we're just going to do simplicity. We're going to go 21,000 divided by 98. That's a 21.4% decline in disposable income. No one's saying she's living like a pauper. No one's saying she's eating cat food, just FYI. So 21,000. Of that, 3,000 was attributed solely to the widow's tax trap. So 3 divided by 21. 3 divided by 21. Hold on a second. What we got to do? Hold on a second. So 3 divided by 21. 14.3% of that reduction in disposable income was attributed to the widow's tax trap. To say that is only, it doesn't matter because the effective tax rate has not been very high. It only amounts to a couple thousand bucks. That's silly. That's silly. 14%, more than an eighth, was attributed to the widow's tax trap. Now, again, did not notice one time I said this woman's eating like a pauper. In fact, I guarantee she's not, because she's probably not doing that much without her husband around anyway, or the husband without the wife. I don't care. But if we had some mitigation strategy to avoid that, would you not want to pursue that? Of course you would. Let's keep going. The widow tax hit emerges from Table 1 as a classic instance of the kind of misleading heuristic identified and checked by an awareness of behavioral finance. Now we start using these terms, heuristic. I remember I was watching a debate on the Trinity, and some guy was like, the heuristics. Like, oh, no, I mean, come on, man. Can we just speak in regular English? I don't even know what heuristic means. I don't care. But it's just like, he's saying, oh, I'm aware of behavioral finance. I read Kahneman. I'm going to scare you, Mr. Jones, so make sure you don't do the widow's tax trap. Why does Ed think people are going to do the widow's tax trap too, by the way? Oh, because there might be something to sell, like a permanent life insurance, a Roth conversions, a trust, a relationship with a new financial planner. Notice he's bashing the industry, but not one time does the financial industry take a hit, or the financial, the academics take a hit here, as if the academics are all that in a bag of chips. I mean, he's sitting there saying these sales tactics, and whatever sales motivates, whatever sales motive underlies the fear mongering. So he's basically, again, he's calling me and my kind fear mongers by saying we have some kind of hidden agenda, be it a Roth conversion, a permanent life insurance policy, a trust, a relationship with a new planner. And by the way, I'd say 80 to 85% of my clients I don't even do Roth conversions for. It just doesn't make sense. Because simply you're paying more tax today to pay less in the future. That doesn't make sense. A lot of these guys, it's too late. You should be doing the 40s and 50s. But in your 60s, it's just not much to do. Not everybody. And if you have a pension, it's tough to justify a widow's tax. It's tough to justify doing Roth conversions with a pension anyway, even if there is a little bit of a widow's tax trap, because your tax bracket is so high as it is with the Roth conversions that even when you die, when you die, it's so far low that what we're trying to do is we're trying to level it off, dude. We don't want to have low taxes when you first retired and high taxes at death. We'd like to avoid that. We don't want to have high taxes when you first retired and low taxes at death. We want a nice, calm lake, a swan lake with no waves, all right? Let's keep going. But again, it says, changes in tax do not represent changes in disposable income. The tax is too small. Too small according to who? That's your own subjectivity. That's not objective. Tax is too small to whom? $3,000 of taxes, an increase of $3,000 of taxes on $76,000 of income is 3 divided by 76. That is 3 divided by 76. That's a 4% increase in taxes, dude. I mean, that's not chump change. That's not chump change. Might be to Ed. I don't know. I've never been a professor. Maybe these guys are rolling it. Crazy. Let's see. Let's keep going here. Table 1 shows that the widow does pay more dollars in tax and does pay at a higher tax rate. But it also shows that when viewed in context, according to Ed's context, the impact is minimal. You can't. That's completely subjective bullcrap. You don't know minimal to you might not be minimal to Grandma Jones. You have no clue. That's subjective. That's not. This is bad writing. It's bad. Straw man and just subjective. Some retirees may also hold an ideological position. This is where Ed shows his cards here, because I looked at Ed's website and I saw the one when Trump got elected and Ed was freaking out. It's crazy. Like literally thought the Nazi stormtroopers were coming. I was like, damn, this is nuts. I can only imagine how Ed was during COVID. I can only imagine. I mean, he lives in California for heaven's sake. But I was like, whoa. So, while these guys with their spreadsheets claimed, and it's not a bash on Ed, I'm just freaking taking it to him because this article has a lot to be desired. It's sad. Because he could have done this article better without basically straw manning, without being subjective, and also these kind of what he's going to, without being a political diatribe here as well. He could have done, he didn't. So anyway, the point being the idea that there's this non-biased academic with his spreadsheets, and he's just being objective to the reality of the spreadsheets is just silly. Well, listen to this right here. Some retirees may also hold an ideological position where reduction in tax paid to the hated government. And see, the hated government is an independent and even primary target for optimization. Fine, but this has nothing to do with retirement planning. Okay, so this is where Ed is not a practitioner. All right, this is what drives you up the wall. All right, you might hate the government and don't want to give him any more to Sniffy Joe, but that has nothing to do with the retirement planning. Retirement planning, according to Ed, must be on sustaining inadequate income. Ed, that's so freaking cockamamie. So freaking cockamamie. So let me ask you a question, Ed. You got Charlotte and Josh. Josh has $1 million in IRA. Charlotte stayed home to raise my kids. Josh, and now we hired my man Jordan. Jordan does the financial planning for me. He's with creative planning. I like creative planning, and I like Jordan. It's not cheap, but I like what they do. All right. Anyway, so Jordan does a financial plan for me. All right. Jordan says you have adequate income to maintain your level of lifestyle in retirement. Thus, we are done. I have a stroke. I don't know who I am. All right. Let's just hear me out. How does Charlotte have access to my money? How does she have access to my money, Ed? You want to take a guess? Through a court order or maybe a durable power of attorney? A durable power of attorney would solve that dilemma very easily, very quickly, without a whole lot of cost, if anything, frankly. But does that durable power of attorney fall as retirement planning, Ed? Does tax planning not fall as retirement planning when we can increase the woman's freaking income by $3,000? Which is 4% of her total spending or total disposable income, which, by the way, is 14% increase her income by 14% of what she lost because she says we didn't do a widow's tax trap worry because it's a non-issue, according to you. Financial retirement planning must be on sustaining an adequate income. Says who? Says where? That's not retirement planning. Retirement planning is everything and all things. It's not just maintaining an adequate income. In fact, I'd even argue if that were the case, and Ed's violating his own retirement planning because we're losing $21,000 right there because of the widow's tax trap, of which, again, the widow's tax trap is only 14% of that $21,000. But if we would have done some planning, we might have been able to mitigate that to some degree. The widow's tax hit may rightly be feared by the ideological, the Republicans. We hate those Republicans, presenting the awful prospect of paying more tax on less income. And see, now he's being silly. It is an awful prospect. Paying more tax on less income is inherently discriminatory. 100%. Because you're saying, sorry, freaking Charlotte, now that your husband's dead, you're going to pay more tax. But I have less income. Yeah. Now, you could argue, well, that's the way singles have to deal with it all the time. I grant you. But for a married couple who is not used to that, all of a sudden the widow takes over, and a lot of times in their mid-70s, that's a big hit. That's a big hit. And Ed might discount the value of that hit, the $3,000 in taxes this woman paid. That's $250 a month. There has a meaning to that. I'd like to see Ed pay me $250 because it's not worth it. That's not a big deal. Just pay me $250 a month, Ed. I'm here. $250 a month. Buy me coffees for $250 a month. We'll just say it's minor. No big deal. You'll be able to maintain your lifestyle. Crazy. All right, but it cannot frighten the planner who stays focused on whether post-mortem income will be adequate to sustain the widow in their chosen lifestyle at the same level enjoyed while both are alive, neither more nor less. And that's not the basis of financial planning, retirement planning. That's not the basis. Because we're not sitting there saying it's up to the client to determine what is retirement planning, Ed. Not up to you to say this is what retirement planning is. Let me force this on you. So we're going to maintain the adequate level for the widow to maintain their chosen lifestyle at the same level of income while both are alive. You don't know that's needed, the same level both are alive. If I die, Charlotte's going to have a higher life income needs because she'd be traveling, she'd be partying like it's 1999. If she dies, I'm not going to do anything. Sit around and freaking eating ribeye all day. That's all I'm going to do. See what I'm saying? So financial planning / retirement planning needs to look at that. It has nothing to do with, it's not solely about whether or not you can sustain an adequate income. This is where Ed misses the boat on what real financial planners are doing. I don't know why. Maybe the guys on Bogleheads have dissuaded him what real financial planning is. Then he talks about some other stupid stuff. I said, okay. Can material widow's tax hit be contrived? All right, so I want to show you right here. There's another example. Right here says, at income of $60,000, both couple and single are located within the Social Security tax torpedo, but the widow is so far into it that their taxable income is almost 2.5 times that of the couple, making their tax about $2,000 greater. But the survivor still satisfies the test of losing no more than 16% of the couple's disposable income. Thus, Ed makes the judgment that the wife will be okay. Yeah, what? The survivor still satisfies the test of losing no more than 16% of the couple's disposable income. Thus, they will be okay. Says who? Well, you're pulling that out of your butt, Ed. Now, can you believe this? And here's the example. They got $60,000 of income. Their total income for married is $60,000. Their total income for the survivor is $50,000 because we're going to lose the Social Security. Their taxable income went from $12,000 to $28,000. That's more than a doubling of taxable income. Yet their disposable income went from $51,000 to $43,000. Now you can say their effective. See, this is it's absurd to me. This lack of tax knowledge. Their effective tax rate is basically the same. It's actually lower for the wife than it was for the husband. You know why it's lower? Because their disposable income is lower. It's actually not a disposable income. It's total income. Her total income is lower. But her taxes, where the taxes go, are higher. So, of course, we have $50,000 of total income. So we take 3,219 divide by 50. That's a 6. Why has he got effective tax rate? Average, includes medical. Okay, whatever. I'm using effective income tax rate. 6.43% is her effective tax rate on $3,219. All right, on that income right there. All right, he had a $1,200 on that income right there. 60,000. 2%. I don't even care if hers is less or not. I care the fact is her income has dropped and her taxes went up. So even if the effective tax rate to include medical, and I whatever, okay. Even if the effective tax rate went up to include medical, I guess what he's doing is he's using the income off the medical. Okay, we'll do that. He's using 3,219 divided by 43,884. 7.3. How the hell is he getting this freaking 13.4? Reduction disposable income is, I don't know, whatever. It doesn't matter. All I'm saying is, even if her effective tax rate is lower than his, the reason it's lower is because she has less income and wish to have the spending power. That doesn't mean she's going to be a pauper, mind you. But he discounts this. Say, look, it's the same. No, it's not the same because she has less income. Now she'll have less mouths to feed. She might not need the money. I don't know. But if there's a way to mitigate that while they're alive, why would you not consider that? It doesn't mean you have to do it. Again, 80 to 85% of my people, I don't do any Roth conversions. But not to consider it because old Ed here is saying, a lot to do about nothing. Crazy. I just love how he just makes a subjective claim that she'll still, she'll lose only 16% of their income. 16% on $60,000? She'll be okay. Crazy. In sum, even at the modest income levels with a more relaxed test for a threatening loss, again, is that an adjective? I think it is, of disposable income, I could not locate a combination of circumstances where the widow's tax hit was material. Well, according to Ed's value proposition, because he said right here, she'll be okay. She'll have 16%. But if we go over the 20%, that's different. Tom Cowan says when talks about heart attacks, you got 93% artery clogged. No problem. If you're 95%, whoa, you're about ready to get a heart attack. Tom's like, so what is it, 82%? Is that okay? I mean, it's the same if you read Tom Cowan's book right here, Human Heart, right here. Of course, A Human Heart, Cosmic Heart by Tom Cowan, How and Why Heart Attacks Occur. And he talks about that. He says, so basically, I'm walking up a hill. I got 92% clogged artery, and I'm okay. Somehow, though, the 92% goes to 95. Now all of a sudden, I'm a heart attack. Okay. So basically that 3% increase from 92 to 95 will cause it. Where's the science for that? There isn't any science for that. It's not. So Tom says, so maybe that's not the cause of heart attack. So Tom's doing the same thing here. He's saying, look, 16% you're okay, 18% you're okay, but it's a 20% magically. At 19% you're fine, and then 20%, you fell off a cliff. That's silly. All right, as mentioned before, the widow's tax hit is a staple among pitches for Roth conversions. All right, so he basically he's using us as our, right here. This actually made me mad. In the context of the guilt appeal, the widow's tax hit functions as an accelerant, helping to light a fire under the reluctant sales prospect. Has Ed actually witnessed this? I mean, are you sitting over there at sales prospects meetings, Ed? For a particular socioeconomic group, it is a gasoline indeed. I observed there to be males who worked hard all their lives but never really got ahead. So he's talking about the Trump MAGA people. He's basically saying, you're going after the MAGA group. You can see this a mile away. It's embarrassing. The gasoline will be higher in octane when there is an irrational phobia of taxes. Irrational according to who, Ed? You and your spreadsheet? To the point of eschewing income on the grounds that it have more I'd have to pay more tax. I have to pay taxes on that, even though the tax payment is a small fraction of the enhanced spending power that might be derived from the additional income. Okay. All subjective. He doesn't know this. He hasn't witnessed this. He's just assuming because he has this avatar of Trump people that hate the government. They don't want to give me any more. Don't give me any more money because I pay tax on it. For this group, as soon as the analysis shows the widow paying even $1 more in taxes, the spreadsheet is shut and the sales are closed. Guilt then drives a death benefit larger than it needs to be, and they'll introduce life insurance and all that stuff. Anyway, and then actually kind of ticked me off here too, because he uses this guy Mayor Statman, and I talk about Mayor in my book right here. I'm probably not pronouncing his name right. You can retire on Social Security, all right? Because Mayor also identifies the fact that your spending drops significantly as you age, and that's just a fact. And I use that in my book here, which you should get. I'm sure Ed would have, and needs to have some copies. All right, so Ed is an academic. He kind of bashes William Reichenstein here. So Bill Reichenstein and Bill Meyer, right there, they've been writing about the tax torpedo for many, many years. They actually wrote Social Security stuff. They have a Social Security program. I've never used it, but and basically Bill is what Ed is saying is the tax torpedo, a term coined by William Reichenstein. I don't know that to be true, and the reason I don't know that to be true because I emailed William Reichenstein back in 2010 or 2011 maybe. Yeah, 2011. I had a guy come to my office, one of my clients in Center City, Philly, Captain of the Navy. He goes, Josh, I got this life insurance salesman. He keeps telling me that I'm not understanding how Social Security is taxed. And he keeps telling me to do this, do that, and the other. He said, and he gave me this article to read, and I read it. It seems to make sense. Would you read it? I said, dude, I'm not going to read the freaking life insurance guy's literature. It's just sales pitch. He goes, but he said, come on, please. And I said, all right. So I put it to put it over there, and I said, I'm never going to read it. A couple weeks later, he goes, Josh, did you read it? Just read that for me, would you please? And it was the best thing I ever read. I said, holy crap, this guy's right. The life insurance guy's right. If you don't understand how Social Security is taxed, you're going to pay more in taxes on less income because of the tax torpedo. So it wasn't Reichenstein that came up with that. You know why? Because I emailed Reichenstein. I said, you ever heard this? Because I'm not sure I trust these life insurance guys. I emailed Reichenstein. He didn't know anything about it. Nothing. There's one guy, one CPA, and I can't remember his name, who had written anything about Journal for Financial Planning, Journal for Accountancy, anything like that. No one else had in the early 2000s. I can't remember that guy's name. I don't even think he was like in my business. I think he was just a tax guy, not even a professor. No one else had written about it, other than the life insurance people. The life insurance people know taxes better than Ed does. I'll tell you that right now. Anyway, so I'll never forget that. I said, damn, this guy's right. And that was the genesis of where I started doing my whole tax bomb your retirement account. So, man, this guy was 100%. Ed Slott, if memory serves, did not write about it in his, whatever his book was called. I forgot what it's called. Parlay your IRA into multi-generational wealth or something like that. I forgot what it's called. Anyway, so I emailed Reichenstein. He didn't know. And Reichenstein had written now in 2020. See how long it took for this to kind of fester? And I think what happened is Ed read these articles, Journal of Financial Planning, saw them being talked about in bold glaze and said, oh, I got to nip that in the bud. Because these guys are, what's Reichenstein doing? Using Roth conversions to add value. Yeah. And even Ed is bashing his own dad. Basically, his dad's probably a MAGA guy because he said, I hope my dear departed father will forgive me for this description of basically he didn't want to pay more tax than he had to. Anyway, I just think it's a cheap hit at the industry. It's a cheap hit at Reichenstein. You know what I'm saying? I don't get it. It's a cheap hit at the idea that to talk about the widow's tax trap inherently means you got something to sell. You're like, I'm going to sell you something, Grandma Jones. Or I'm going to feed on your MAGA, worry about paying Steffi Joe more tax than you have to. It's silly on its basis. It's speculative, it's subjective, and a straw man. And it's just based on pure just nonsense where Ed is choosing what is appropriate for you as opposed to you choosing appropriate for yourself. That doesn't mean you have to do it. But if to be ignorant of this is not bliss, dude. Ignorant of the tax code is not bliss, and this proves it right here. Love your thoughts. We'll see you guys.